Hey everyone, my name is Brendan McKay. I'm the broker owner of McKay Mortgage Company. We're a local mortgage brokerage in the DC metro area. And recently we've been working with a ton of clients to help them refinance with the historically low interest rates that are going on right now. And a lot of them have the same questions, and we've kind of developed our approach. And we think kind of the best way to be looking at refinances and exactly what you should be paying attention to and what value there is. So I wanted to do a mock walkthrough of a client presentation that I do many times a day so that you can see what you should be paying attention to when you're talking to your local broker or thinking about refinancing. And at the end of this, if you would like a specific workup for your exact situation that we're going to walk through, shoot me an email, leave a comment in whatever format this is on, and I'd be happy to do that for you. So what we're looking at here today is a client that actually I just worked with recently with their information removed, but their home value is at $565,000. This first column right here shows their current mortgage, okay? So they owe $391,000. Their interest rate is 3.875%. Here's their principal and interest payment, and here's their taxes and insurance. So their total monthly payment down here is $2,564. So when you're thinking about refinancing, the first thing you want to do is try to get as much of an apples to apples comparison between your current mortgage and the refinance as possible. A lot of times when you look online or somebody sends you a quote, it's for a new 30-year and maybe all the closing costs are rolled in and it's not really the same. So how do you get it to be the same? So in this case, this client was 3 years into their mortgage. So the very first thing I did was show them a 27-year refinance. A lot of lenders actually do offer 27 or 26 or whatever year mortgages. A lot of them don't. But even if the one you're working with doesn't, you can turn a 30-year into a 27-year or whatever, and I'll kind of show you how before we finish. So on this column right here, this is what would be a 27-year mortgage. So it stays on the exact same pace and the exact same balance at $391,000, $327,000. So it is an apples to apples. Interest rate is 2.99%, so significantly lower. APR is something that a lot of people have heard of, but they don't always know exactly what it is. APR is a representative figure. The goal of APR is to help you compare one mortgage option to another or one car loan to another and get an apples to apples and really know what's happening. You can get two mortgage quotes from two different lenders and they could be the exact same quotes and they are not the same. One may have a bunch of additional closing costs and the other doesn't. And APR is an attempt to show one number that's a universal figure that lets you kind of see that. So in this example, 2.99 and 3.033, they're very close together. So you want them as tight together as possible, and if there ever is a gap between them, it should be an indication to you, hey, what's going on here? There's some extra cost. It might just be mortgage insurance if you have less than 20% equity is required, or it could be something else. So it's a tip for you to kind of, alarm should go off and you should say, what's going on here? Principal and interest payment is $1,761. Property taxes and insurance are going to stay the same. And you can see right here, the payment goes down by about $190 a month, which is awesome. And saving $190 a month is definitely a benefit and a reason to refinance. I don't think it's the main reason though for most people. You should look at refinancing the same way that you look at saving into a retirement account. You're not doing it to put a couple bucks away and see it grow the next month or take the money out the next month. You're doing it to see what will happen over a medium to long period of time. And in this particular example, over a 10-year period, this client will save over $32,000 by refinancing, and that's a really powerful number. $190 is nice, but it's not going to change a lot of people's lives. But $32,000 will. That's a significant amount. That's the way you want to be looking at refinancing. How much interest am I saving over a long period of time? That's the benefit. These are the closing costs. $2,642 is the total for the closing costs for this option. We're going to hop over to another sheet that breaks all of these down. This is a fee worksheet. And any lender down on exactly what you're looking at. And when you're comparing one lender to another, you want to be focusing on lender-related fees. There's also third-party fees and closing costs and prepaids that we're going to go through. Those are not going to change from one lender to another, but one lender may estimate them differently up front than the other does, which can be very confusing. So you want to hone in on lender-related fees, which we can see up here are things like admin, underwriting fee, processing fee, discount points, and sometimes you get a credit towards closing costs. McKay Mortgage tries to structure every loan without any of these fees, and we're generally successful. So you can see on here all that there really is an appraisal for $495, which is going to be standard. Some areas are going to be a little higher than others. $35 for a credit report, also very standard. And then down here are the third-party fees and escrows. These are going to be the same no matter who you work with. So you're looking at $950 for an attorney fee, $1,000 in this case for lender's title insurance. It's entirely dependent on the loan amount size. Recording fee for $150, so you're looking at $2,600 total. And then we're going to hop back for a second. This over here, this $4,500 in escrow prepaids and reserves, this is the most confusing part of refinancing. This is money that's collected at closing, but it is not a net cost of refinancing. And what I mean by that is your current mortgage has an escrow account, and you pay into it every single month, and it builds up every month. And if we look at it in this example, we can see it's $498 for taxes, $117 for insurance. It builds up every single month. And when taxes and insurance are due, your lender pays them out automatically. There's always this floating amount of money in there. Now, typically, you can't just take that pot of money and move it over to your new loan. So you have to collect a new one at closing, which is the bulk of the $4,500 that we're collecting in this example. So we collect a new escrow account, but you get the old one refunded back to you after you close. It usually takes a month or two to process. Your old lender will send you a check in the mail for the balance of your escrow account. That will wash out the majority of this $4,500. The rest is covered by the fact that when you close on a refinance, you collect at least 30 days worth of interest at closing. And because you collect 30 days worth of interest, that represents a mortgage payment. You do not have to make a mortgage payment the month following closing. So if you close in August, for example, you would not have a September mortgage payment. So between getting your escrow refund and not making a mortgage payment the month following closing, this $4,500 is washed out entirely. So it is not something that you should take into account when doing a cost-benefit analysis. So in this example, we're keeping the loan amount the same, so you're bringing the closing costs and the escrows to closing, which totals $7,150 down here. This rightmost column is if you just started a new 30-year fixed over again. It's the same loan, it's the same interest rate, and it's the same closing costs. So if you wanted to, you could close on a 30-year mortgage and say, hey, I know I have a 30-year, but I want it paid off in 27, and you would simply make an additional principal payment every single month to your new 30-year loan for the difference between these two numbers, which is about $104 a month, $114 a month. If you pay $114 extra a month on this 30-year option over here, it will be paid off in 27 years and be exactly the same. And whether you do the 27-year or the 30-year, in a vacuum, the 27-year is a better mortgage when you're only looking at the mortgage. But if you do a new 30-year, as long as you're doing positive things with that money, whether it's paying off credit card debt or saving towards retirement or whatever it might be, it's fine. You're fine financially. You should just do it eyes wide open. So that's really the most important thing with it, because in their bones, they are the same mortgage at the same rate and the same closing costs. I want to hop over to another way to structure it as well. These these options are the same. The only difference is that you can see the loan amount has gone up. It's gone up from $391 to $398. So you owe more money on your new mortgage. And the reason that you would do this is because you do not have to bring anything to closing. You're actually getting $5 back in this option. This is what a lot of people refer to as rolling in the closing costs, rolling in the escrows. So in this example, your mortgage is higher, but you're bringing less to closing. You would still get the escrow refund. You still would not make a mortgage payment the month after closing. So you would actually be cash flow positive, in this example, about $4,500 a month or two after closing. And once again, keeping your mortgage balance the same is better in a vacuum. My advice is, if you have a lot of liquid savings and you're where you want to be there and you have a great amount of job stability, keep your mortgage balance the same. It's good basic, financial practice. That being said, if you don't, or you simply don't want to, or you have a better use for the money, once again, if you have credit card debt, don't bring anything to closing. Use that escrow refund check, pay your credit card balance down. This is more of an option. One is not better than the other. Some are better for some people and some are better for others, and that's really how you should be looking at it. Thanks for watching my presentation today. I hope that was helpful. That is what I walk through clients many times a day, and what we talk to them about their refinances and what's important to them. If you have any questions, feel free to leave a comment in the section below, or you're welcome to email me directly. My information is on the slides that you're going to see at the end of this. And also, if you would like me to run a scenario specifically for you and your specific situations, just email me a copy of your mortgage statement. I'd be more than happy to do so. Thanks for taking the time.